everyone, and welcome back to yet another episode of Get Real with Jack and Cindy. I'm Cindy Morrison.
I'm Jack Wallace. Here we are. Let's get real.
Yeah.
So it's really good news.
Yeah, we love good news. Did we mention we love good news?
We've been waiting for a long time for the rates to start ticking down, and they are. In fact, we had the largest drop in years the other day in mortgage rates. So now, before we go there, does not mean we're heading to 3%.
We will probably
we're heading to 4%.
We will probably never see 3%.
Never
again
say
in our
never,
lifetime.
but yeah,
probably never.
Not in my career, probably.
Yeah.
But I will say this: if we can get into the mid to high fives, we can get even into we are in the low sixes now. Now these are all averages too. It's also difficult to talk about interest rates and what they are. People always say, "What is the interest rate right now?" Well, what is your credit and how much are you trying to buy, and are you a veteran or are you FHA? I mean, like how much you're going to put down, like all those things have an impact on what the actual interest rate you receive ends up being.
Mm-hmm.
So when we're talking about this, we're talking kind of broad brush about where they are.
And you can ask for, let's say, $10,000 in concessions from the seller and use part of that to buy down a point. I mean, I believe if we can just get under 6, you know, that 5.99.9, just under 6, and that's, I feel like the magic bullet. But a lot of people are on the fence waiting for interest rates to drop. So if you wait too long as they begin to drop, interest rates are going to go down, but your competition for homes is going to go up.
So I will say this, I think it's really important for us to emphasize this. When you are listening to the news and they're talking about the Fed bringing the interest rate down,
yes,
that is not mortgage rate. That is not related. It is loosely related to the mortgage rate.
But it is not the mortgage rate.
It's more going to be your credit cards. It's going to be short-term lending, which also has an effect because if your debt to income, if you're making a lower payment monthly because your credit card interest comes down, that can help your debt to income. It can mean you chip away more principal on your interest when you're paying those things. So those things do have an impact, but it's more just kind of looking at the overall health. We just had a jobs report or jobs readjustment that came in almost 1 million under what they thought we had in employment for the last year, and that really kind of shook things up a little bit. So the not good news being good news, but then you also have to let it not be such bad news that it's actually bad news because the economy is going to fail. So there's this weird scale that goes on. So sometimes when you hear, oh, the jobs report was terrible and inflation is up a little bit, that can be in respect that means that they're going to make those adjustments as far as the interest rates and mortgage rates go.
So I did
it's confusing.
Yeah, I put together kind of a very simple version of what all this means in a video. And basically the Fed rate is banks exchanging money back and forth overnight, kind of like if you borrowed your friend's car overnight.
It's their overnight borrowing rate.
Correct. When you get to the mortgage rate, that has to do with jobs, the economy, and inflation. Now, anticipating that the Feds are going to make a change here next week, lowering it, already the mortgage rate has begun to tick down in anticipation.
Yeah, and then the other thing too, we always look at, and I know if you've been listening to us, you're tired of hearing me say this, but it's the 10-year Treasury is what our competition is for mortgages. And what do I mean by that? So whenever a investor is looking, and I mean a big investor, like a portfolio buyer investor is looking at what they're going to do we buy a package of mortgages or do we buy a 10-year Treasury? Now, why would those be comparable? Because most people stay in a house about 7 to 10 years. So a mortgage is a 30-year mortgage, but most people keep it for only 7 to 10 years. So those two instruments are the closest basically in portfolio that people can do. And so when investors are looking at those, they're going, well, do I want to do that or do I want to do this? They're always kind of having to balance that. And then they add a few extra points to the mortgage because of the volatility factor of it. that other one, the U.S. Treasury is backed by the government, which used to mean something more than it probably does now, but still, it's, we are still thought of as one of the most secure investments. So that's why it isn't exactly. So like right now, the 10-year just went to 4.001, which is huge. If we can get under 3, that's even better. And the mortgage rates are like 6.26 or 6.1 something. But I was also talking to a lender earlier today, and they were saying that this week they won't bring the price of the mortgage down because they know that next week the Fed is going to do that.
Mm-hmm.
And so to make that look like a better thing, they'll wait and then do a drop when that happens, because
Mm-hmm.
it'll make the market look more attractive to people. So we've also had a 3-year, like you were saying earlier, 3-year, it's been 3 years since we've had this kind of interest in mortgages.
Mm-hmm.
So people are back looking at what they can do and what they can buy.
Especially those that have been sitting on the fence, and interest
Mm-hmm.
rates, are important. I mean, it does change not just your monthly, but what you pay overall for the house. So a lot of people have been just on the fence, just waiting, like my dog to pounce on its toy when the interest rates drop. The thing is, if they do drop significantly next week, it may not be enough to make a huge difference on your mortgage between this week and next week. But as soon as the news reports that, you're going to have all of these people who've been poised to pounce jump in to look at houses.
And the thing that people don't really realize, because they don't do this all the time, but like, let's say I go out and I find a house today that I want to purchase, and I go in and I tell my lender I want this house. And so then they put me in, then they give me this rate. Well, then next week it drops. I can float until the rate goes down. So next week, whenever the rate's better, they can lock me in if we want to.
So you've locked in the house, just not your
right.
rate
So
yet.
so people that are waiting for the interest rate to be 1/8 or 3/4, whatever that is next week, and are not going out this week and doing it, well, the people that are out doing it now might get the house you want, and then next week you could have grabbed that. So I think there's a little bit of education that needs to happen in that. If you're going to be in the next 30 days, find a house and close, you have some time to lock that rate in. I've had them lock in a rate 2 days or a day before closing.
Oh, wow.
Because there was a change. So don't get bogged down that I have to wait till the exact perfect rate happens to go out and find the exact perfect house. Like you've got a little bit of leeway. I mean, it's kind of like you'd want to be comfortable with where it is right now, worst case scenario. But if it went down a little bit, great. So.
And I get all the people that, jumped in and bought a house when it was, 3% and refinanced. Absolutely. But so many people have just been sitting on that 3% and not quite sure what
they've been paying a lot on their principal too. I mean, the good news is a lot of people have more equity. In Oklahoma, we have a really great, it's one of the best equity states. People have the most equity in their real estate in Oklahoma. So that's really
Isn't
good.
that amazing?
Yeah.
And we pretty much stay cool as the other side of the pillow, minus, minus, what was that? 1984, 1985,
Yeah.
But really our real estate stays steady. We've continually been ticking up.
COVID was a jump up. Yeah.
But you've got some states like California, Texas, Florida, their property values are not staying steady at the moment.
And I mean, I'm doing some price reductions on some listings that have been for a while. So I mean, right now you're kind of in a good sweet spot where you can go out, and houses have been on the market for a while. People are kind of ready to get a deal done and you can get a better price, and interest rates are coming to a manageable. I mean, this could be a real sweet spot for somebody who is ready to go and buy something. So,
and the best time for you to buy a house is when the time is right for you.
Yeah.
Interest rates, I mean, probably you're going to refinance anyway here in a few years, but the best time is when it's right for you. So don't just go buy a house because the interest rates drop. Don't not buy a house because they didn't drop where you feel like they should be. Yeah. Do what's best for you. Don't buy into a lot of the media hype. And I can say that coming from the media. So.
But I also think it comes down to, we really are in a place where people are listening to so many TikTok and all of that, and it's like, even the date the rate and marry the house, and that's biting the people in the butt. I mean, like,
Yeah.
because they couldn't refinance, and like, don't ever put yourself in a position that if the best case scenario or the better case scenario doesn't happen, you're going to be really screwed. Because
Right.
if you're comfortable no matter what where you are right now, but hope for something better, that's great. But I mean, I think that's the thing. But I think right now I wasn't pushing people. Like,
Mhm.
and I've done this a long time. I wasn't pushing people because it was like, how can I justify telling people to leave their 3% to take on a 5% and move down and the size of their house for a higher payment?
Right.
And so, but now we're really getting into the place where you can take equity that you've built, you can buy down interest rate, you can get into something for less money or the same money and improve. So now we're in that place where it's easy to work those numbers, and we've had enough time. So I think that's kind of where we are. The other thing is, I think it's really important that everybody realize that basically you're renting from yourself.
Yes.
So when you're buying a house, that monthly payment is the same as if I were to go and rent something. I'm paying myself, I'm my own landlord basically. But what is your monthly that you can absolutely meet no matter what? That is really where people have to look at. And I think as a sellers, um, we've had to really explain to them that that's where people are, and that because the interest rates have gone up so much, that it makes their monthly off. So what used to be a $1,500 a month is now $2,500 a month, and that means that the house they can afford comes way down in price, but prices have gone up. So that's why we've had one of the slowest markets we've ever had, because we've had that to deal with. And so we're getting the rebalance now.
And we mentioned in the last episode, a price adjustment is not a bad thing.
Mhm.
The market is going to tell you what your house is worth. And, if you're looking at, making a killing on your house to retire, if you're looking at, my house must be worth X because, I've seen it, I've seen the numbers and we ticked up this much, whatever it is, we can come out with the comps and look at what we think your house is going to be worth, but the market is going to tell us. Price adjustments are adjusting to the market.
Mhm.
And
we bring the house to the market, and the market brings the price. That's how it works. We try to come up with the best estimated number we can, looking at all of the statistical data and looking at what has happened around you with other buyers.
We're looking at past data to come up with that.
But this house is not exactly like your house, no matter even if it's the same exact floor plan. It is different. There's different factors. So, and the public that was buying 3 months ago could be different than the public that is buying now. So all those things, we do the best we can, but the market's going to tell you where it is. And to your point, I think we're going to run into a little bit of a pushback from sellers that have had their house in the market for a while, saying, okay, now I don't want to make a price adjustment because the interest rates are coming down. The interest rates aren't plummeting. The interest rates are coming down enough that if you can make a price adjustment and people feel good about the price and they have a better interest rate, they're more willing to act.
Right.
So don't think that it's like, oh, well, now they're coming down and it's going to just be an on-fire market. It's going to take a lot for it to be an on-fire market. I mean, I think we could get there, but it's not going to be a quick on-fire market.
And if your house has been on the market and it hasn't been selling, 9 times out of 10, it is not your real estate agent's fault. If you have done your due diligence and picked an agent that is a strong marketer, a strong negotiator, they're savvy with the numbers of what homes are worth, you've done all of the things. Mm-hmm. Just because we've had a small pool of buyers recently is not your agent's fault.
Right. I do think it's when it comes down to, and I've said this before, openly admit this, like, I think one of the issues that if I look at my career and the times when I haven't been the best agent I could be, it was because I was so afraid of having to tell somebody something that they didn't want to hear, mm-hmm. or not arguing enough to help them understand what they need to know about the market and what's going on. And so I think we have to deal with reality. And, our job is to get everybody the best deal possible. And that's really what we want. I mean, on both sides of the equation, but it's like, I think that is a misnomer. I think sometimes it's that the market, if you have 4 buyers in one house, and that's a whole different thing than if you have 4 houses and 1 buyer.
Mm-hmm.
And so you have to look at what market you're in and what that means.
And we have been the 4 houses and 1 buyer because buyers have been a little skittish. Our inventory has finally gone up for the first time since 2020.
Right.
So right now, it is more of a buyer's market, at least here in Tulsa.
And it depends neighborhood to neighborhood.
Yes.
And that's why you really need an agent who knows what they're doing to come out and go, okay, your neighborhood, this is what's happening. This neighborhood, 2 down, completely different story.
So as a buyer buying in a buyer's market, you're going to get more concessions. You might get the house for less. If those interest rates, tick down just enough, then suddenly it's going to be more of a seller's market because you're going to have these buyers coming in. Hopefully we won't get back to the multiple offer situation like we had in 2020, 2021, 2022.
Unless you're a seller, and then you hope that, right?
Yeah, exactly.
Yeah.
But, for buyers, like I said, just, keep a watch on the interest rate, but now's the time to look in, to jump in and start looking, because it appears the interest rates are only going to continue to go down from here, which means more buyers, which means more eyes on the houses that are out there.
Right. And the other thing too, if you are a seller, it's really important to understand that a lot of people have wrested their house from the market, or they're frustrated and they're thinking about, this is probably the worst time to do that. Like, yes. I think now you can't market your house if you're not on the market. I mean, I think if you want to get it sold, this is the time to be in the market, because as those prices start to come down, those monthly prices start to come down. So let's say that, like, the monthly price comes down when the interest rate comes down. Mm-hmm. So when those start to come down,
because the house price stays the same.
Yeah, then people can afford more because that lowers that price. So, the other thing too, that I've never in my career, and I've been in this for a long time, I've never seen such a price sensitive market. And that seems surprising to people, because you would think that would always be the case. Mm-hmm. But people used to be kind of like, you know what, I can go another $25,000. That's not a big deal. I really want this house. But now people are like, no, this is the most I can do, because they've
already gone up that $25,000 or $50,000 or $100,000 from what it would have been in.
I think they're going to their lender and they're finding out, like, for a house that I want, how much is it going to cost a month that I can afford? Mm-hmm. And then they're being told what they can afford. Used to, they would go, well, I don't need that much house. I'm willing to go, down a little bit from that. And if I have to, I'll go back up. So people would go look at houses that were 20 above what they were expecting, because they knew they could do that. But right now, I think people are stretching. So when they're out looking, they're looking at pretty much the top of the market. And so if your house is 5, 10, 15, 20,000 over that, they just won't look at it. So that's kind of an interesting thing that we've not experienced in a long, I don't really remember that being the case. But I mean, if you sweet spot pricing right now and you go down 5, 10, 15, depending on the price point of the house, but it's amazing how much difference your showings can make, even with a $5,000 price adjustment. Like, yes. Suddenly there's a lot more demographic buyers who can do that. So now if we compound that with interest rates going down, that can even make even more of a difference, because people in that category, there could be a whole lot more of those people.
Sure.
So yeah, it's good. It's exciting. I mean, it's been a long time since we've had something really exciting in real estate to say.
And the mortgage engine, that's pretty scary when you have a podcast, but
we've had a lot we had to say,
yes,
to help people, but it's fun that we're seeing something, moving in a really good direction.
I, a couple of weeks ago, I was the keynote ending speaker for the Oklahoma Mortgage Bankers Association at Shangri-La, and it was a great crowd to speak to, because we're in line with each other. We sell the houses, they fund the houses, and it was great to see them excited about the future of mortgage rates and where they're going.
Yeah, Well, and it's like Berkshire Hathaway. He just did. Why am I having Warren Buffett just spent a lot of money on new construction companies, and that was like everyone's going, does he know something we don't know?
Mm-hmm.
And it's always funny. Like, remember when he took all the money out of stocks, and then the stock market fell, and like, what? I mean, it is kind of eerie, but it's like he was like putting his money in. Okay, now because if interest rates go down, new construction stops that stall. They can start getting back in there and doing, because they've been making so many concessions that they got to a place where they finally just couldn't make enough concessions to meet the what needed to happen. But now they will be able to. So yeah, it's an exciting time.
And it used to be more expensive to buy a new construction home than an existing home. Curtains and just the expense of building it and all of those things.
That's new car smell. Yeah.
Yes, that's not really the case anymore. They're pretty close, neck and neck. One other thing that I've seen is a lot of the developers, which would affect new construction. So I think there will be a boom. A lot of the developers were selling everything they had in 2020 through 22, and they didn't have time to develop anything new. So right now, if you're wanting, a pretty neighborhood with some land, let's say half acre to an acre, right now, at least here in Tulsa, there's not a lot of that right now. And so if you're in new construction and you can help develop that, you're going to sell homes, because we see that. I see that all the time with my builder. They want those bigger lots since COVID.
Yeah.
And there just wasn't any development of that.
That's been even before COVID. I mean, that has always been an appealing thing to people, and it's very difficult for the builders and developers to make that work, because land is so expensive. And then by the time you go in and put all the infrastructure into the land to develop the neighborhood, then people always think, well, they bought it for $1 million and they put 40 some houses or 100 houses in here. Yeah, but they had to pay for all the streets, all the sewers, all the gutters, all the pull electric to everything. I mean, all the things. And then on a half acre, a lot of times they have to do a septic, which is expensive. So I mean, there's a lot of things that go into. It's like people have a dream of, this is what I want. Then they realize, oh, but if I want that, I'm going to pay this amount for it.
Right. Yeah. Right. So I agree with the new construction. I hadn't heard that, so I'm glad to hear that. But anyway, just be thinking about when the time is right for you to move. I mean, I've been in my house 28 years. I just haven't seen the time to move. Plus, I'm so busy helping other people buy and sell their house.
Well, I think even for I hear a lot of younger people saying they just don't feel like they can afford a house. And
25 to 40.
Yeah.
And the majority of them say they can't afford a house.
And so I think it's really nice whenever we see any kind of movement that makes it a little bit more affordable for that. And that's the other thing too. It probably is like now. I do think now is a good time to start looking into it, because if you need to be getting your finances in shape, if you need to be saving, if you need to, you'll learn what you need to do by talking to lenders now, and you'll know when your timeline is, what to go, and be ready to pounce whenever the time is right. I think people have just given up and stopped and pulled out, and so now it may be time to get back in there and just kind of put yourself in and see what's possible.
Yeah, absolutely. Putting your toe in the water will give you a great idea of what all's out there.
Yeah, and we are still going to do the one first-time home buyer seminar. We're going to come up with that soon. So this is perfect, because now we kind of been waiting a little bit because we wanted this to happen. So now we're going to get to where we can start really figuring out how to make this affordable for people.
And we're excited. All right, well, thank you so much for joining us today. We will have another edition next week.
Thanks for joining us.